There is a risk building in the global financial system right now, and it is not coming from Washington, not from the Federal Reserve, not from inflation, not from crypto regulation. It is coming from Tokyo. A single decision by the Bank of Japan could quietly force trillions of dollars to reposition across global markets. For years, investors have been trained to watch the Fed. Every word moves yields, equities, and crypto within seconds. But while markets focus on the United States, one of the world's most important liquidity engines may be shifting beneath the surface. The number to watch is 0.75%. On its own, that sounds irrelevant. But in global finance, what matters is not the level of rates. It is the structure they support. And for decades, Japan has supported one of the most critical funding structures in modern markets. If that structure begins to adjust, the impact may not arrive as a crisis. It may arrive as volatility, especially in risk assets. By the end of this video, you'll understand why institutional desks are watching Japan and why the next liquidity shock may not originate in the United States. Hi everyone, you're watching Global Macro and Crypto. Today, we're breaking down a mechanism that has quietly supported global risk-taking for decades, and why a potential shift by the Bank of Japan could become one of the most consequential macro developments of this cycle. This is not a story about panic, it's a story about structure, because markets are not driven by growth alone. They are driven by liquidity. Economic expansion helps, corporate earnings matter, innovation attracts capital, but sustained bull markets almost always share one foundational condition. Money must be easy to access. When the cost of capital is low, risk becomes easier to justify. Leverage expands, duration looks attractive. Investors move further out on the risk curve in search of return. This is how valuations stretch, not necessarily because optimism explodes, but because funding makes patience affordable. And that raises a critical question. Where has the world been sourcing cheap money for the past 2 decades? Very often, the answer has been Japan. After the collapse of its asset bubble in the early 1990s, Japan entered a prolonged period of slow growth, weak demand, and persistently low inflation. In response, the Bank of Japan pushed interest rates towards zero, and in some periods below it. What began as a domestic attempt to stabilize the economy gradually evolved into something much larger. The Japanese yen became the world's primary funding currency. Stable, abundant, extremely low yielding. In practical terms, it became one of the cheapest currencies on earth to borrow, not temporarily, but structurally. And from that environment emerged a strategy that many institutional investors still rely on today: the yen carry trade. The mechanics are straightforward. Borrow in a currency with very low interest rates. Convert that capital into a higher yielding currency. Deploy it into assets that offer superior returns. Capture the spread. At small scale, it looks unremarkable. At global scale, it becomes one of the most powerful liquidity engines in modern finance. Think of it as the hidden plumbing beneath markets. You rarely see the pipes, you rarely think about them, until the pressure changes. For years, yen-funded capital has flowed into US Treasuries, corporate credit, equities, emerging markets, and increasingly into digital assets. Not because Japan directed that capital, but because cheap funding lowers the threshold for risk-taking everywhere else. This is why liquidity often matters more than narrative during long expansions. Stories justify positioning. Funding enables it. Now, carry trades persist only as long as 3 conditions remain intact. First, funding rates must stay low. Second, yield differentials must remain attractive. Third, currency volatility must stay contained. When those conditions align, the strategy can endure for years, even decades, quietly reinforcing global risk appetite. But when one of them shifts, the math changes quickly. If Japanese rates rise, borrowing becomes more expensive. If the yen strengthens, repayment costs increase when positions are converted back. If currency volatility increases, hedging becomes more costly. At a certain point, the spread that once justified the trade begins to compress. And when that happens, investors don't usually wait for losses to appear. They adjust. Sometimes gradually, sometimes faster than expected. Carry trades rarely unwind politely. They tend to deleverage under pressure. Let's pause here and reset the frame. This is not about predicting a crisis. It's about sensitivity. Modern markets are deeply interconnected. When a major funding source becomes less accommodative, capital allocation decisions ripple across asset classes, even if the original policy shift appears modest. And historically, higher beta assets tend to respond first. That includes crypto. Not because the underlying technology changes overnight, but because liquidity conditions do. Bitcoin trades on narratives, adoption, halving cycles, institutional participation, but it also trades on global funding dynamics. When liquidity expands, capital searches for return. When liquidity tightens, capital prioritizes balance sheet resilience. This brings us back to the number that has captured the attention of macro desks: 0.75%. Relative to the United States, that sounds insignificant. Relative to Japan's modern monetary history, it is not. For decades, global markets have operated under the assumption that yen funding would remain exceptionally cheap. Entire portfolios, risk models, and leverage frameworks have been constructed around that premise. When a long-standing assumption begins to move, investors reassess. Think of it like a bridge that has carried light traffic for years. The structure appears stable, not because it's invulnerable, but because it has never been tested. As conditions change, the margin for error narrows. Some analysts describe levels like this as a potential pain threshold. Not every rate adjustment creates stress, but there is often a zone where leverage becomes less attractive, risk limits tighten, and capital begins to reposition. If that adjustment unfolds gradually, markets adapt. If it happens quickly, volatility tends to follow. Now consider the second-order effects. When the yen strengthens, the USD-JPY exchange rate typically moves lower. That shift often coincides with tighter global financial conditions. Funds facing higher funding costs may reduce exposure, not because they want to exit risk entirely, but because balance sheets demand flexibility. And when investors need liquidity, they usually sell what they can sell, not necessarily what they want to sell. Highly liquid assets often become sources of cash. Bitcoin fits that description. It trades around the clock. Market depth has improved significantly. Large positions can be adjusted quickly without waiting for traditional market hours. That does not make Bitcoin fragile, but it does make it responsive to liquidity transitions. At this point, a reasonable counter-argument emerges. Central banks communicate well in advance. Institutional portfolios hedge currency exposure. Risk is monitored continuously. All of that is true. But financial history offers a consistent reminder. Major adjustments rarely come from risks that were invisible. They come from risks that were visible, but underestimated. Awareness is not the same as absorption. So, what paths could unfold from here? One scenario is slow normalization. The Bank of Japan moves cautiously. Rate increases remain measured. Currency movements stay orderly. Carry trades contract gradually. In that environment, the impact may feel more like a headwind than a shock. Risk assets could consolidate rather than reprice abruptly. Another scenario involves speed. If the yen appreciates rapidly, leverage positions may face tighter constraints sooner than expected. Risk managers tend to act decisively when volatility rises, not panic. Discipline. And disciplined deleveraging can still move markets. There is also a broader implication worth considering. For years, the Federal Reserve has been treated as the gravitational center of global finance. But liquidity is not controlled by a single institution. It is a network, and sometimes the next catalyst emerges from outside the usual field of view. The next volatility event may not speak English. So, what should investors monitor? Many macro desks are watching USD to JPY, not just direction, but velocity. A gradual move suggests digestion. A sharper move can signal repositioning beneath the surface. Bond yields across developed markets matter as well. So, do measures of currency volatility and cross-border funding stress? These indicators rarely generate headlines in real time, but they often provide early clues about changing liquidity conditions. Let's zoom out. Bull markets rarely end simply because they have lasted too long. They evolve when the cost of money changes. That doesn't mean every tightening cycle ends a rally. Markets are adaptive, but valuation frameworks are always tethered in some way to funding. When capital is inexpensive, growth is rewarded and duration looks attractive. When capital becomes selective, investors demand stronger justification for risk. Periods of tightening serve another function. They reveal positioning. When leverage retreats, price discovery improves. Excess is reduced. Stronger hands replace weaker ones. Volatility, in that sense, is not purely destructive. It is clarifying. The key is preparation rather than reaction. Instead of asking whether markets should be worried, a more useful question is this: if global funding conditions shift, how sensitive is your framework? Are you watching price alone, or the forces shaping price? Let's bring everything together. Japan has spent decades as one of the world's lowest cost sources of capital. A move toward 0.75% would signal a meaningful adjustment in that funding landscape. If yen-funded strategies begin to contract, risk assets may face a less supportive liquidity backdrop, not as a certainty, but as a probability worth tracking. Macro awareness is less about prediction and more about orientation, because in global markets, the most important shifts are often the quietest at first. In the next video, I will challenge the idea of Ethereum as the digital bond of the internet and explain why its evolution is becoming the only thesis that matters for institutional capital. Thanks for watching Global Macro and Crypto. I will see you in the next one. If this added clarity to your perspective, hit like and subscribe. Now, let me ask you this. Are markets still too focused on the Federal Reserve, while a potential liquidity shift is forming in Japan? Leave your view in the comments below. This content is for educational purposes only and does not constitute financial or investment advice. Always do your own research.